Trading is exciting. The potential for big wins is thrilling. But hold on, before you jump in, you need a plan to protect your hard-earned money. That's where risk management comes in. It's not the most glamorous part of trading, but it's the most important. Think of it as your financial seatbelt. Risk management is all about protecting your trading capital from big losses. It's not about avoiding losses altogether, that's impossible. It's about managing those losses so they don't wipe you out. Trust me, even the best traders have losing trades. The key is to make sure those losses are small and controlled. Imagine this. You put all your money into a single trade and it goes against you. You panic and lose a significant chunk of your capital. That's a nightmare scenario. With proper risk management, you can avoid such disasters. It helps you stay in the game longer and gives you the chance to recover from losses. Risk in trading is the possibility of losing some or all of your investment. It's an inherent part of the game. You can't avoid it, but you can understand it and manage it effectively. The first step is to identify the different types of risks you face as a trader. There's market risk, which is the risk of the market moving against your position. There's also liquidity risk, which is the risk of not being able to exit a trade when you want to. And don't forget about leverage, which can amplify both your profits and your losses. Understanding these risks is crucial. You need to know what you're up against before you can develop a plan to manage it. Remember, knowledge is power. The more you understand about risk, the better equipped you'll be to handle it. You've heard the saying, don't put all your eggs in one basket. Well, it holds true for trading too. Diversification is one of the most fundamental risk management strategies. It's about spreading your risk across different assets and markets. Think of it like this. If you invest all your money in one stock and it plummets, you're in trouble. But if you spread your investment across multiple stocks, even if one or two perform poorly, the others can cushion the blow. Diversification can be applied in various ways. You can diversify across different asset classes like stocks, bonds, and commodities. You can diversify within an asset class. For example, don't just buy tech stocks, buy some healthcare and energy too. Section 4 Stop Loss Orders. Your emergency exit plan. Imagine you're driving down the highway and your brakes fail. Scary, right? Stop loss orders are like the brakes in trading. They're designed to limit your losses on a trade if the market moves against you. A stop loss order is an order you place with your broker to automatically sell your security when it reaches a certain price. Let's say you buy a stock at $50 and set a stop loss order at $45. If the stock drops to $45, your order will be executed, limiting your loss to $5 per share. Stop loss orders are crucial for managing risk, especially when you can't constantly monitor the markets. They act as your safety net, protecting you from potentially devastating losses. Remember, emotions can run high in trading, and stop loss orders help you stick to your plan and avoid making impulsive decisions. Section 5. Position sizing, calculating your risk appetite. Position sizing is all about determining how much capital to risk on a single trade. It's a critical aspect of risk management that's often overlooked by novice traders. You need to find the sweet spot between risking too much and not risking enough to see decent returns. The key is to determine a percentage of your trading capital that you're comfortable risking on any single trade. This percentage varies depending on your risk tolerance and trading style. A common rule of thumb is to risk no more than 1 to 2% of your capital on a single trade. For example, if you have a $10,000 trading account and you're comfortable risking 1% per trade, your maximum risk on any given trade would be $100. This means you would adjust the number of shares you buy or sell to ensure that your maximum potential loss on the trade is limited to $100. Section 6. Mastering risk, mastering trading. Mastering risk management is essential for long-term success in trading. It's not a one-time thing, it's an ongoing process that requires discipline and consistency. Remember, protecting your capital is your #1 priority. By implementing the strategies we've discussed, such as diversification, stop-loss orders, and position sizing, you can significantly reduce your risk and increase your chances of success. Remember, trading is a marathon, not a sprint. So before you place your next trade, take a step back and assess your risk. Have you diversified your portfolio? Have you set your stop-loss orders? Are you risking an appropriate amount of capital? By making risk management an integral part of your trading plan, you'll be well on your way to achieving your financial goals.